Were you surprised by the extent of Fed Chair Powell's comments in terms of really putting it out there that this is where we'll be at for possibly years to come?
Well, I watched the press conference this afternoon, and to my eye, he was even a bit more animated than typically a central banker is in emphasizing that the Fed is going to stay the course here. And I do think he talked about a tough job ahead, particularly getting the unemployment rate back down to where we had it earlier this year. That may be a multi-year kind of process. But I think there should be no question in people's minds that the Fed is going to stay the course here with accommodative policy that's going to support a conceivably fairly long-term process of bringing the economy back.
So everyone, of course, wanted to know about where the state of, robust discussions behind the scenes are when it comes to yield curve control. And he said there's been open discussions, but no indication as to effectiveness in this situation. Is that something that the Fed should be considering as the economy reopens and there's greater suggestion that it could be more effective rather than just potentially even further blowing out the balance sheet if they need to do more?
Yeah, I think this was a discussion meeting. In some respects, a planning meeting. They always have to work toward consensus on how they're going to deploy various policies. And in this meeting, I think they are looking ahead and anticipating multiple scenarios in terms of the evolution of the economy, and probably don't yet have a clear consensus on whether to do, for example, rate caps or exactly how to express forward guidance. But I'm sure they had a very thorough discussion of that.
Well, it seems
they are in effect pausing for this meeting and perhaps the next before they actually begin to use some of the other tools in their bag.
Well, Dennis, it seems to me that Jay Powell, his forward guidance was very clear when it comes to the economy. But that forward guidance, does that come back to bite them at some point? 2.5 years, we are saying we are not going to hike rates. How weak does the economy have to stay? At what point, maybe in a year or so, do they say, oh, gosh, I guess we could remove some of this stimulus? That seems to me they're in a tough spot potentially.
And they didn't guarantee it, Kathleen. They basically, I think if you were to probe Powell and others, they would say, well, our policy statements are always conditional on how things evolve. And so if miraculously there's a much better outcome in the economy, they will reconsider. So there's no guarantee that the policy rate will be at zero for 2.5 years, but as they see things now, that's the way they're thinking.
Well, and I'm glad you pointed that out, because even with the dot plots, which we just showed a couple of minutes ago, that's how it is. But I want to ask you, because you were a banker, you had a long career in the U.S., around the world. So as a former banker in particular, what about your concerns about a possible stock market bubble? Your concerns about people taking on more debt, more leverage, because, hey, the Fed's there, they're going to keep buying bonds, they're not going to raise rate, money is almost free, go for it.
Well, we went into this crisis with pretty high debt levels, and the private sector was fairly highly leveraged. And now we've had a real drop in demand, and many companies are reeling and at the moment. I think it'll be very interesting to see what the take-up is of this Main Street lending program, because I think one way you might look at it is that companies are going to be reluctant to add debt. They're going to try to basically get into survival mode in other ways and work their way through this without adding more debt. So that remains to be seen. We'll see. But debt levels are a concern, I think, across corporate America.
Are they getting to a point where they're flirting with moral hazard here, though, Dennis? We heard that suggestion from William Dudley just a few days ago. I mean, have they essentially, with the language and this narrative, backed themselves into a corner where they're not willing to rock the boat for risk assets?
You know, in my experience when I was at the Fed and certainly under Jay Powell, I think it's clear that they're going to stay focused on their mandated objectives. They're going to stay focused on the real economy, and they're going to follow the financial economy or the financial markets as they affect the real economy, and not make policy that's designed to have an effect on asset prices one way or the other. In the press conference today, Powell emphasized that. He basically eschewed the idea that they would undertake policies to try to affect asset prices. So in that sense, policy is a little bit uncoupled from how equity markets particularly are going to go. And the concern would simply be a financial stability concern if there were an enormous sell-off of some kind.
Well, Dennis, you know, people talk about yield curve control, not just in the U.S., because, you know, we talk a lot about Asian central banks on these shows, and the same question, yield curve control. Do you need to put a cap on yields because you're issuing so many bonds to pay for all the money, all the stimulus you've got to do after you put the lockdowns on, right? And the economy's got, in some cases, pretty much crushed. Do you think that's going to guide the Fed as well? Is that such a big concern for the Fed that you've got to keep the yields low because otherwise it's going to cost you a lot more money to finance a much bigger deficit?
I don't think that's the foremost issue in their minds. I think the consideration of yield curve control relates to maintaining financial conditions across the whole spectrum of interest rates that are adequately accommodative to support the recovery. And so I would view yield curve control, which may in fact be implemented sometimes later this year, as sort of similar to the QE we had after the financial crisis of 2008. And that was to try to keep control of long-term interest rates to support housing, to support the auto industry, and to support business investment. Capping interest rates would be another way of trying to do that, to ensure that the markets don't take those rates far away from where the Fed wants them.